As for the latest inflation print today and where the market goes from here, let's bring in Point72 Asset Management Chief Economist Dean Maki and CFRA Research Chief Investment Strategist Sam Stovall. Morning, guys. Good to see you both.
Morning, Carl.
Sam, let me talk with you first about, I guess you're drawing some caution into looking at periods after the first cut, right? It's not always roses.
Oh, that's right. Well, Carl, it's the big difference between wanting and having. That in the period between the last rate hike and the first rate cut, the S&P has gained an average of 18% going back to 1990. Yet in the 30 days after the first cut, we end up seeing the market tread water, gaining less than 0.5%. Most of the action is below the surface, however, in the sectors areas, with a lot of the leaders being in the defensive areas. But I have to include technology in there because investors don't want to be giving up on the growth.
Right. That said, you are looking for maybe a post-election rally. Am I right?
Absolutely. So typically the seasonality gets shifted during the election year. Instead of August and September being weak, it's September and October. And you look at a majority of styles, sizes, sectors, and sub-industries in negative territory in September and October. But then the reverse is true in November and December. Once the uncertainty of the election has been lifted, you find that all sizes, styles, sectors, and 97% of the sub-industries are in positive territory, led by more of the growthy areas.
Dean, how about you? How are you thinking about today's print? And what is on the line for retail sales in terms of what the path should, whether it's 25 or 50, what the path should look like from here?
Well, I think the bottom line is we remain pretty optimistic on consumer spending. If we look at the labor market, consumers are still getting solid labor income growth, and inflation is coming down, especially gasoline prices. And that's giving strong real income growth to consumers, and we think that will keep them spending. Also, household net worth right now relative to income is higher than it was at any point in the 70 years prior to COVID. So we think that is also supporting consumer spending at this time. So we remain optimistic on growth right now.
Does it also support higher inflation numbers? You know, the market and the Fed is feeling so confident that inflation is in the rearview mirror. But if you continue to see this real wage growth translate into better spending, does that keep inflation still a risk?
Well, we have seen a tremendous moderation in inflation. So I think we have to give the Fed credit there for bringing inflation down. I think it's always a risk if if the Fed were to cut too fast. I think if the Fed were to cut in the way the market is expecting them to, then I think you would be seeing, late next year into 2026, some risk of inflation reviving back up. But I don't think the Fed is going to cut at that kind of a pace.
So you're not worried about these sort of hotter core readings and PPI today and CPI yesterday? Doesn't feel like the street is too worried about it, although it does reverse a recent trend.
Yeah, I mean, the inflation numbers are going to go up and down. And I do think there's a risk that the Fed doesn't get inflation all the way down to 2%, that it gets stuck in the 2.5%, 2.75% range. That's not a disaster, and it wouldn't cause the Fed to retighten, for example. But I think in the near term, that is the main risk on the inflation front.